Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting Tracking the Forex Market Together webinar, and it is given once a month, and it is a twin webinar. That means I give the forecast and also the trading ideas during the European session, probably the start of the European session, and also try to show the results of the trades which are being taken during the European session, during the next part of the webinar, namely part 2, that is given during start of the US session. So it is a twin webinar. Once in a month, I focus more on the trading part of it, besides the market reading. So this webinar, I like to dedicate more on the trading strategies. So if you have got any doubt pertaining to that of the trading strategies, what I am following, or any trading ideas you have, and you can propose and we can discuss over it. So that way we'll be able to fine tune with regard to the trading strategies one need to adapt in the volatile market, because market is known to be volatile all along, and in that process we should be able to earn, we should be able to view the volatility as a trading opportunity. For that we have to get rid of the market fear. And if you want to get rid of the market fear, more understanding of the market is needed. Because when the market gives surprise to us, that means we have not anticipated that, and the market has moved against our expectations, then we become surprised or stunned. And once you become stunned, it aggravates the market fear. As a result, we keep away from the market if you have not taken any position, or we try to close the position in a distress condition when the market starts moving against us, even briefly. So for that, I am just giving you a simple market tracking technique, and with the help of this simple market tracking technique, I'll be able to focus more on the effective trading strategies and how exactly the tracking and the trading strategy could be used to earn consistently from that of the market. So for that, we need to use the following components. Okay. Now in this particular live market code page, they have changed the timings. So I have to use the GMT time from FX Street, which is on the top menu of the home page. So, because people try to outsmart by giving disturbance in live market code page, still we will be able to come out of that. That's not a big deal. Now, the market tracking technique. So, in order to track the market, I'm using the statistically derived algorithm to determine what will be the expected market moves for the intraday and for the day, week, month, year, etc. So that algorithm-based forecast gives the broader outline of the market and how exactly the market is expected to behave. Then I fine-tune the market reading, the derived forecast, using the market reading technique. And the market reading technique is the one wherein we try to closely track the players, how they intend to make the moves in the market. We try to find out, and they basically act in a very cunning way to start with, in order to induce the traders to develop a market sentiment, and then later on they act against the traders. Day in and day out they do the same. So we have to find out when they are going to express their cunningness. When they express their cunningness, we find out whether it is a real cunningness or it is their genuine intention. So once we differentiate, we are in a position to take the position. And afterwards, our reading can go wrong. Always we keep in mind that we are not God, and we know that we are bound to commit mistakes. And in the process, in the event if we have committed a mistake, and we cannot ask anybody to come and protect our trade. We can only protect our trade. So we expect the unexpected, and in the trading strategy, use the hedging order to limit the risk. As soon as the position is taken, we try to keep the hedge order to limit the risk. And later on, we try to trade continuously by keeping stop at entry and also make it as a trailing stop in a profit-making position. So that way we try to maximize the profit. So this is the overall picture, and in which we are going to see the fine-tuned aspects of the market reading. So for the market reading, the most important thing is the market timing. Why the market timing? Because the market is 24 hours. And in the 24 hours, they cannot continuously make the volatile moves. And in order to make the volatile moves, they have to do the circular trades. The players need to do the circular trades. And when they try to do the circular trades, you find here, they have to continuously oscillate or make a small dip, make a small rise, make a small dip in some more currencies, etc. They have to continuously make the rise and the drop in the market. Only then traders will be able to see, okay, this reaction is for the fundamental moves. Okay, now they have come closer to that of the support. Why not we buy? It has come closer to that of the resistance, not able to breach and go above. Okay, why not we sell? That sort of trading decisions people might be able to take. So for that, they have to swing the market, or they have to make the moves in such a way so people will be able to ascertain that the market is alive. And only when they feel the market is alive, and they will be able to take positions in the market. Otherwise, if the quotes are static and there is no change with regard to the pips, and then the traders will also wait and not take positions. So the prime most important thing of the player is to make the circular trades and make the market swing. And if needed, they make the volatile moves. So all these moves are being done by the other players. And we cannot even make one pip move in the market. Whatever be the volume of position we like to take, still we will not be able to make euro to drop one pip or rise one pip. And in the trading platform, you know very well, you can only place market order. And if you place the market order in the MetaTrader platform, say for example, suppose euro, the bid is 1.3567 and the ask is 1.3568. And you know it is in the fifth decimal in the trading platforms. If you keep the order 1.35675, it will not display it there. And you can keep the order, but it will not be displayed. And it shows very clearly that our orders are not being taken there. And these are all nothing but the orders of the players, and they try to make the moves in the market. So we need to understand how they are trying to play with us. And still, it is a great opportunity to earn money and a quick way of earning money. But in the process of earning quick money, we should not lose the money quickly. For that, we need to have a perfect understanding. Everybody talks about education, about the market. But when you go into the details of the content of education, we find more of the distractions. Because basically, you find that the market is known to make the swings, and how the swings are made, no explanation is given. And why the market is making volatile move, no explanation is given. And also, why suddenly the drop and the next day the sentiment changes and the market reverses and goes in the opposite direction, no explanation is given. So ultimately, what we need to find out is, it is more of a theoretical nature, but practically we have to expose yourself. It is something like how to drive a car. You can just read it in several books, but that is of no use unless and otherwise you have a hand-on experience in driving a car. And once you go into that of the hand-on experience, we know that the body has to synchronize with that of the vehicle, and we have to make the pedals to push and monitor and do it in a very synchronized way. You have to hold the steering and just maneuver the market, navigate the road, and you have to see that we are not hitting anybody. At the same time, we are not being hurt, So we have to do several monitoring. And after some time, you find that you drive the car at ease. Even you don't bother which gear you are. Automatically the body takes over the control of the vehicle. And how? Because you habituate yourself and learn the art of driving. So it is the similar way you have to learn the art of trading. In order to learn the art of trading, if you go in for the distractions again and again, you are not going to perfect it. And there is a difference between an experienced trader from that of a professional trader. A professional trader is the one, he accepts if he has committed a mistake and he try to rectify it if he finds that he is going the wrong direction. So he is the first person to make a self-evaluation, whether I am going in the right direction, whether I am doing the market reading as it is happening in the market, or simply following somebody like a herd of traders, and I am trying to just to follow the same technique and say that, okay, 70% of the trades I'll be able to earn, and the market is unpredictable, and the market, nobody will be able to predict the market. I can continue to say that. And that means I'm cheating myself. We have to find out, because it is a man-made market. In a man-made market, men should be able to find other man's mindset. And we have to find it either directly or indirectly. There are various ways by which one can read the mind of the other man. And so, in one such mechanism or the process, I have identified the session timings followed by that of the players. So the session timings are from 0030 to 7 GMT. 7 to 7:30 is the gap time. 7:30 to 13 is the European session. 13 to 13:30 is the gap time. 13:30 to 20:30 is the US session. And the gap time is 20:30 to 0030 hours. So you find the three major sessions in a given day or a 24 hours market. And in between the sessions, you come across the 30 minutes gap time between Japanese and Europe, and between European and US, there is a gap time. So European session started around 7:30 GMT. We are now at 8 GMT. So it is 8:13 GMT. So once you know that the market has started, and we will try to read in the live market code page. And in that, we know very well, each session is subdivided into early, mid, and the late sessions. So now European session 7:30 to 9 GMT is the early session, and 9 to 11:30 is the mid session. 11:30 to 13 GMT is the late session. So during the early and the late sessions, they handle the majors. During mid sessions, they handle the crosses. So we are in the early session, so we will try to focus on the majors, how exactly they have done the moves in the market. And also, we know that they take only two currencies at a given time and try to make the moves in the market. So we have to find out what are those two currencies. A currency which has made more than 40 pips spread, especially the majors, more than 40 pips spread between the high and the low, is an active currency in a particular session. If you see that Euro has not made 40 pips, USDN has made 40 pips spread. And GBP, just now they made the 40 pips spread by just hitting the initial low. And in the case of CHF, it has not made. So here in the case of Euro and CHF, they are making subdued moves and they are handling USDN and GBP. Now, you come across in the case of Canadian dollar, no 40 pips spread. And also in the case of Australian dollar. So at a given time, they only handle two pairs. So we identify the two pairs they are doing it is USDN and GBP. USDN is showing 42 pips negative net, positive net change, and GBP is showing 42 pips negative net change. So when they are making equal, then obviously you will not come across any impact with regard to GBPN. So GBPN is holding with a narrow range in the middle level. So what currency they are trying to do it? They are trying to handle in a very small way Euro and USDN and GBP and holding the other currencies and trying to handle the crosses to start with. And you know that there is no active data release is seen today. So in the absence of data release, the traders might hesitate to enter into the market, and they want to have a clear picture because the traders normally confirm the market direction using the fundamentals as well as the technicals. So when the fundamental data is not available or not to be released at a given time, then they look for the technicals. And in the technicals, you find more of a consolidation, and the currencies are in a narrow range. So in such a situation, they avoid taking positions. Then when the traders are not taking position, there is no big point, or there is no point for the players to make big moves in the market. Because if they simply make a rise or a drop, they don't earn anything unless and otherwise the traders come in and lose the money. So that's what you come across. Still, we will try to take the positions. I will try to explain to you after giving the details pertaining to the market timings now. So you come across the sessions and sub-sessions, and early and the late sessions, they handle the majors, and mid-sessions, they handle the crosses. Keep that in mind, and this webinar is being recorded, so you will be able to have access to this later on also. I show this slide during the Asian session live market analysis also. Try to remember the session timings. Then you will find exactly during start of the session and the end of the session, they make quick moves in the market. We'll be able to understand, okay, they've got a purpose to make moves in the market. Now, how to use the live market code page and try to read the market. Now, this is the live market code page. And only thing is the GMT time is being altered. Still, I'll try to manage it with the help of the GMT time available here. Now, Euro is currently trading around 1.3564 and GBP USD yen is around trading around 97.10 and GBP around 60.53. USD CHF 90.59. When you look into that live market code page, sorry, we have to note down the high, low, and the net change in 4 majors and 2 commodity pairs. So here you come across the high, low, and net change. And normally we have to note down around 3:30 GMT, the high, low, and net change. And that is considered as the initial high and the initial low. So I already noted down for your benefit, and I'll show you the slide. Okay. These are all the initial lows and the highs of Euro, all the 4 majors and 2 commodity pairs. So Euro formed the low of 1.3560. Okay, 1.3558. They formed the new low by cutting it by 2 pips and gone above 1.3565 during the early session. So what we do, we try to take a buy position. I'll jump into that of the trades so that I can take time to explain later on. Okay, 1.3565. I'll take a buy. And then stop 30 pips below. Now, in the case of GBP, 1.6052 is the current level, and 1.6052, they are near the low, and you find that Euro formed 14 pips negative net change, and USD yen formed 39 pips positive net change. GBP is making about 42 pips negative net change. But, so USD CHF is making positive net change. So you find the majors are showing the USD gaining move. Whereas if you look into that of the Canadian dollar and Australian dollar, they are making the contrarian move. Canadian dollar is making the USD gaining move by gaining the net change. And Australian dollar is making the USD weakening move by gaining the net change. So that means they started handling the process in the absence of major volume coming to the market. So we will try to find out what we can do. Now, the second important thing is, okay, the net change indicates the current market level from that of the previous day close. Watch when the market is near low or near high, and relax when the market is in the middle level. Majors are active during early and late sessions. Crosses are active during mid-session. That's what I explained to you. Now we need to understand the type of moves they make in the market from the start of the session and how we identify what they are trying to do what is going to be the next move in the market. Now, in the case of Euro, I explained that 1.3560 was the initial low. And what is this? A move which happens in less than 30 minutes during the early and the late part of the sessions. That is, now it is the early session. So it is 8:21 up to 9 GMT is the early session. So a stop point is the one in which they go above the initial high or go below that of the initial low for 15 to 25 pips and reverse less than 30 minutes. So they cut the low by 2 pips. Initial low 1.3558 is the new low, 1.3560 was the initial low, and they come above that 1.3564. Okay, in less than 30 minutes they are cut and come up during the early session. So it is just as brief, 2 pips stop and they come above. And sometimes what you come across is they go up to that of the initial high and reverse, or go up to that of the initial low and reverse. And that is referred as a false move. These false moves happen during the gap time. I explained to you the gap times here. Gap time between Japanese and the European session, between the European and the US session, and before the start of the next day. They are all the gap times. During gap times, they make the false move. Then, a move which happens more than 30 minutes. Sometimes they make a move more than 30 minutes, up to 2 hours. Now we come across in the case of GBP that. That's why I want to show it with an example, and that will make you to understand it easily. Now let us take GBP initial lows and highs. GBP formed the initial low 1.6074 and currently it is 1.6044. And you would have noticed during the gap time they just made a small firming up and they come up to that of 1.6074, 76, 77 and then quickly came down below that to 1.6074 and started holding it. And that indicates that they made a brief upward false move in the case of GBP, and they have been holding below that of the initial low for more than 30 minutes. If they hold below that of the initial low for more than 30 minutes, that means they will hold below for 2 hours to start with. And in case if they need to drop further, then they may continue beyond 2 hours by cutting the new low continuously. So how to identify that move? So GBP found the initial low 1.6074. The high is intact, it's not breached. But in the case of GBP, they just breached the initial low and come below. And how much? 30 pips. They come below 30 pips and holding it. If they stop cutting the new low for 30 minutes, understand that they induce the traders to sell, thinking that it has just gone below that of the support. And then subsequently, when the traders take sell positions or liquidate the long position, they absorb and slowly gain. So without giving profit booking opportunity to that of the short sellers. Only then when they rise, the short sellers will come for short covering. It is a sensible game. So they have to induce the traders to take sell positions and then rise the market quickly. Automatically the short sellers come for the short covering. Because in a market, if you take the position, you can't take delivery of the currencies. You have to invariably liquidate the positions unless and otherwise you do the currency conversion trades. Otherwise, in the leverage market, whatever the position we have taken, you have to necessarily close it. So they know very well, you cannot go anywhere, you have to come and close the position. They gain the level and hold, and there is no other go than to cut loss. So they formed the low 1.6044. The time is around 08:13. I was showing you. They just cut the last one. So now about 13 minutes over, and let us see how far. 10 to 30 minutes, if they don't cut it, then you find that they are going the other way. Sorry. Okay. So it is called the extended move, in which they breach the initial low and form the new low or new high and stay below that of the initial low for more than 30 minutes. And what happens? Up to 2 hours, they hold it and then come above that of the initial low and straight away go and cut the high. That is called extended move. So extended move, when they've done and when they stop cutting the new low for more than 30 minutes, you can try to take a buy. Now almost 13 minutes is over, and if you are really smart enough, we'll be able to understand, okay, they have stopped cutting that. In 10 minutes, we should be able to identify it. So let me take the buy position at okay, 1.6045. I'm just taking a buy, and 1.30 pips below 1.6015, the entry stop. Okay, then let us see how exactly they are doing it. And in case if they are missed, probably we can just make it as 1.6049. I am just explaining to you the way in which we have to analyze the market and trade. Now, we'll go to that of the market trading. Okay. Then in case they cut the low and stay below the low and continue to cut the low, new low, every 30 minutes, then that particular move is for more than 2 sessions, 2 hours. And when they make it for more than 2 hours, they continue to do that for 2 sessions in the start of the 3rd session. And that is referred as the intentional move. And intentional move is the one which is always a slow move. And they continue to make the drop and continue to cut the new low again every 30 minutes. And during session change, they make a small pullback and continue to cut the low and drop. And that sort of move, they try to do it for 2 sessions and the start of the 3rd session and quickly drop and reverse the market. So that we need to understand. So always the intentional move will be a slow move, and the extended move will be a quick move. So quick move, you can differentiate it from that of the slow move. And that way you can find out whether they are going to continuously drop or continuously rise. So now in the case of GBP, they cut the low by 1 pip. So this is how they try to do it. And if you watch 30 minutes, you will be able to find that market gets stabilized. But the way in which they cut the new low, you can find out whether this is the end of it or they may continue to make the drop. And so in order to avoid the ambiguity, and suppose if you want to watch all the 30 minutes to find out whether they are stopped cutting it, but they may not stay closer. They might have just gained at least 20-30 pips. I would have missed the opportunity. So what we do is we keep the hedge order to limit the risk. So we take at a given time only 30 pips risk. And if the going is good, we try to keep stop at entry and remove the hedge order. So that is the simplest way of handling a position and managing the equity. At any given time, taking a risk for 30 pips is optimal because they make the swings for about 15 to 23 pips at a given time. So when they make an up and down, they normally make for about 15 to 23 pips. And if you keep 30 pips hedge order, it is not to be filled so easily. And see, normally what happens when the traders keep the stop, they try to find out the strongest support and keep the stop below that. It might be about 100 to 150 pips below that of the entry. It is fine, but when they make the drop and when they see that usable margin gets eroded, they become afraid and cut the positions. So it is not of a convenience to keep the stop, and it is a question of protecting the equity. So when you want to protect the equity, we have to see that we only take a minimal risk and maximize the profit in a given trade. So that should be the objective. Hence, we keep 30 pips hedge order. So these are all the major types of moves, namely stop hunt and a false move that happen in less than 30 minutes. And extended move is the one which happens beyond 30 minutes up to 2 hours. Then the intentional move is the one which happens for more than 2 sessions and the start of the 3rd session. Then during that of the dull time, you come across the swings, either near that of the low or near that of the high, or they try to make the swing between low and high. And when they do not cut the low or high and make the moves within that particular range, it is referred as swing. So these are all the only type of moves they can do in the market. And for the past 18, 20 years, I've been watching it, and they are not able to change the type of moves because they don't have any other method of trapping the traders. So if you just understand them, we will just laugh at them and not become afraid of their moves in the market. Now, coming to the trading strategy. See, I explained to you that use the hedging. So a sell stop or a buy stop in the MetaTrader platform, or entry stop, which is also called as entry stop in some other platform, in last making position, and trail the stop and trail the stop and the limit, or take profit order. The limit is otherwise known as take profit order in profit making positions. So as soon as they take the position, we keep the hedge order to limit the risk. Once the position makes profit, we keep stop at entry, and then you trail the stop when the market is moving in our favor, and also we trail the take profit order on the upside, so that the market will be making swings between the trailing stop and the take profit order. And when they continue to rise the market, automatically you trail the stop on the upside and also the trailing limit. Then what happens? You are able to maximize the profit in a very systematic way without any speculation and without taking much of a risk. And that is more important. So we take their entry, watch for 30 minutes from the start of the session, and identify what sort of moves they have done it. So in the case of euro, they had just done a brief downward stop. So we had taken a buy and come above that of the initial high, low, and stayed there for more than 30 minutes now. They are still staying above. Then, in the case of JPP, they made an extended move on the downside below that of the initial low and formed the new low and stopped cutting the new low for 30 minutes, 10 to 30 minutes. Then we try to take a buy. Then they will start making a rise. We can predict it so easily, and there won't be any ambiguity. And there is no importance to that of the levels. Today, it will be 1.3563 and 1.3558 could be the low. Tomorrow, it could be 1.3612 could be the low. Doesn't matter. We just watch the initial low and the high they are set and how they are handling the stops below that of the initial low, stops above that of the initial high. And those stops are placed thinking that it is a initial low, or thinking that it is day's low and try to keep the stop below that, or thinking that it is a strong support area, keep the stop below that. Okay, when they see the cluster of stops below that of the low, when the herd of traders keep all the stops there, they make one big drop, like this in the case of GBP for about 30 pips, and then started reversing it. What happened to our analysis? And we find that, okay, GBP has to go up, and we had taken a buy, but kept the stop near that of the support and kept the stop. But they just dropped and hit the stop and started going up. We don't have a position to do that. In case if we use the hedging order in the trade, then we can see whether the hedging is making profit. If it is not making profit for 10 to 30 minutes, that means they simply hit during that extended move or during a stop. And we simply close the hedge order with a nominal loss and keep another hedge order to limit the risk. Then they start gaining the levels. Whereas if you simply keep the stop, they hit your stop, and the market will ridicule at you that you have kept the stop. Many of the time, the traders avoid keeping the stop when they find the stop is being hit so easily, because they think the support is a very strong support. Extended hand is given below the currency so that the currency cannot drop. They are all theoretically derived levels. And in the market, there is no hard and fast rule that support has to really act as a support. The resistance has to act as a resistance. Nobody dictates that. And we only theoretically calculate, and we expect the theoretical calculations are to be honored by the market. How can you expect it? Theoretically, we derive so many things. And if you, in the practical life, if the theory has to work, and we know that we have to fine tune whatever we have derived it on the theoretical basis. We do need the theory. We do need the analysis. But we should not blindly go with that. We have to fine tune it depending upon the market conditions. And only then we will not get fooled by that of the players again and again. In a robotic trading, when you just program it to algorithmic trading or automatic trading, and it will simply close the positions, and that is what you come across. Most of the algorithmic trading and most of the auto trading techniques work very well in a trending market, and during that of the monthly trend reversal, it just wipes out all the money earned. That is why you find that people go for it just thinking that somebody can earn my money so that I can relax and just enjoy the life. Anything which comes without hard work does not sustain. Then exit, take profit, order near that of the opposite level. So we have taken a buy near that of the low. We try to find where the high is. And when they try to breach the high and just stay above and see whether it is a stop end or an extended move or intentional move on the upside, then you try to maximize the profit. Otherwise, we keep the take profit level as 1.3582. So this is the trade. We keep the high as the limit, the exit level to start with. And once we are able to see that market is making move above our buy, then we try to keep stop at entry. About 15 to 25 pips they move, we try to keep stop at entry. Then we try to move the exit or the take profit order upward. And once that stop is removed and we keep, or the hedge is removed and keep stop at entry, in the event if they drop the market, we don't lose anything. We just find a better level to enter into the market again, because we understood that they wanted to make a rise. In a small swing, they may hit. Doesn't matter. But once they set the trend in a session, they don't change it. So we continue to buy, and if you want, if you are a smart trader, you can accumulate more buy once you are able to keep stop at entry and take another buy, and if the market goes up, then keep stop at entry. And finally, when they stop cutting the new high, book profit and all, you'll be able to really take the massive profit. So ultimately, you have to develop the trading ideas depending upon your market understanding. We should be able to get the hard feeling. Okay, in a session, they don't make trend reversal. Between sessions, they make trend reversal. And in a day, They don't make all 3 sessions a continuous trending move. They only do for 2 sessions the trending move. The third session, they just make the opposite move. So that is why I used to say that they don't make hat tricks. Hat trick is the one more than 2 times. If it gets repeated, it is not called as a hat trick. But they don't do that so that the traders would develop the bullish feel and buy. If they don't book profit, they incur loss because they reverse the market. So they give only maximum of 2 sessions a chance for you to book profit. Otherwise, the position may show lesser profit or a loss. So we need to understand how they play in the market, how they make the swings in the market, induce the traders to commit position. They make quick dip in the case of GBP in order to create the market sentiment. And immediately people think, okay, when GBP is dropping, euro has to fall. Other day, euro was staying around 1.36. GBP came from 1.62 to 61. Okay, then afterwards they are going to drop euro. Then if you try to take a sell there, they may simply rise the market. That is why I always say that don't correlate the currencies because they induce the traders to correlate the currencies. For example, now, when euro is showing negative net change and GBP is showing negative net change, if I presume that Australian dollar has to drop as a numerator currency, then I might be deceived because it is showing positive net change and they will just slowly cut the high and go above, and that may be followed by that of euro and GBP. So never compare the currencies. They are not comparable and we can only find coincidences with regard to the moves. And if you think that they are real comparable condition and we do a lot of correlation coefficient analysis and say that, okay, 60% correlated, 70% correlated, they are all theoretically fine, but not permanently they are correlated. That we need to understand. Okay, at the given time they are correlated. After 2 hours, you find they are not correlated. So you won't be knowing whether you can follow GBP and take a position in euro or follow CHF and take a position in GBP. That is not at all possible. So one need to understand there are a lot of misguidance here, distractions here, and we have to fine tune which is relevant to read the intentions of the player. Now, I am not trying to blame anybody because only where people can expand out of the theoretical knowledge. But what is more important is the practical knowledge. What is happening in the market? How exactly you can just earn money from that of the market. It is something like a subway wherein you have to walk through and catch the train, and in between you come across a lot of pickpocketers. And you know that you have to protect your purse, and also at the same time you should not get distracted, and you have to catch the train. So there comes your smartness, nothing more than that. Because there are a lot of people to deceive you, a lot of people to misguide you, distract you. Because if your purse has to be lifted, you have to be distracted. Keep it in mind. And they just give such adequate distractions, you get convinced, and it will appear as if those people are coming voluntarily and extending enormous help for you. But this is mainly to grab your purse. Okay. So as far as the trading is concerned, I had taken 2 positions. I'll explain to you during that of the next part 2 of the webinar, how exactly the trades are handled during the day. Okay, there are questions. I'll try to answer the questions. Okay. Danny, how do you know what currencies they are going to handle? As I explained that the currency which is making more than 40 pips spread between the low and the high, they are handling at a given time. Then slowly they will increase the spread in other currencies and then started making the moves. By the time the moves will become visible to us, that means either the USD weakening move or the USD gaining move. Those 2 types of moves will be visible. But in between they will make the contrarian move. At the time we need to find out what are the 2 currencies they handle at a given time. Then try to take the positions in them. Now USD yen also, but I don't find time now to explain because it is already 8:45 GMT. So otherwise, no, in the case of yen, the initial high was 97.01 and currently it is trading 97.09 and it's not dropping. That means when they cut the initial high and stay above that initial high for more than 30 minutes to 2 hours, that means they wanted to gain more levels. So one can take a buy position in the case of USD yen as a technical trade, but a technical trade is the one which has to be closed within the day. You cannot convert into a position trade. Okay. Then Aditya, can you please take position in any cross? Probably during the European session, I'll try to take the position in cross and explain to you. Then finally today I understand your approach. Okay, thank you. That is why I thought that I can make it more figurative expressions with a lot of slides. Then Aditya, once a move has been identified, what is the best way to join the move? Okay. Now, when I see that it is a stop and I know that they stop cutting the new high or new low. See, they are rising it. So, new high or the new low, when they stop cutting it for 10 minutes, once you really understand the market, within 10 minutes you will be able to understand it. So, for that, without any distractions, you have to only look into the live market quote page, no chart. Then you will be able to really get the market inside. Because here, all the currencies are comparable at the same time. What type of move they are doing, it will be able to understand. So when they cut the low and form the new low and reverse and stay above that 1.3560 for 30 minutes, 10 to 30 minutes, that means they want to rise. So that is a stop and. Once you become master of identifying the type of moves, during such quick dip, you can buy. Then they will rise and you will be able to improve upon the profitability. Nothing more than that. It is further fine-tuning of your understanding of the market. They cannot do any other move. I can give it in writing. You just find out what sort of moves they can do it in the market. They cannot do any other type of moves. And they have to repeat it because for the past 18, 20 years, I have been observing they are not able to do any other thing to cheat the traders. So, you understand they have got the limitation. As long as they are human, they have got the limitations. And you know that they cannot openly do it and they have to do it as a hidden agenda. And if they openly do it, it will be considered as insider trading. You know that it is punishable. So once you identify it as a stop and after coming above that at the initial low and stay there for more than 10 minutes to 30 minutes, you can take a buy. Otherwise, during the downward stop and when they form the new low, stop cutting the new low for 10 minutes, take a buy. Okay, you will be able to find out. And when they form the new low and continue to cut it in another 5 minutes, okay, it is going to be an extended move. And that too, when they gain from that of the earlier session up to that of the initial low and drop again, understand that they are making an extended move for more than 30 minutes up to 2 hours. Then after waiting for some more time, you can take a buy when they stop cutting the new low for 30 minutes. So that way you will be able to join when they make the moves in the market. And as soon as you see that position makes about 15 to 25 profit, keep stop at entry. So that you don't incur loss. In the process of making money, we should not lose. And don't say that I am capable of taking more risk. And it is simply, there is no bravery associated with taking risk. And smartness with regard to the risk is you should avoid the risk. Because it is a hard-earned money, why you should lose it? And it is not at all bravery. And simply keeping a 50, 60 pips stop or a 70 pips stop is not bravery at all. It is stupidness. Because you are willing to accept the loss, but when the loss comes as a reality, you are not able to face it. You keep away from the market and start giving it in the forum and the chats and things like that, various other type of expectations and try to justify what you have seen. That is of no use. Unless and otherwise you earn money for yourself. Nobody else is going to earn for you the money. We can just fool ourselves by just giving enormous expressions and things like that in various networking and public forum. But ultimately, what is more important for us is consistently earn money from the other market. And so there are a lot of distractions, and you can participate in that, but without changing your mindset, without being disturbed. If you participate, it's fine. And if you are moved with others saying, that means you don't have a strong willpower and strong mind and conviction, and you don't have the trust in your own system. Then only you tend to listen to all other people and finally get confused. And every new method you will try and experiment and lose money. And another new method you will try, experiment and lose money. And by that you are the loser. So ultimately what I suggest is, if you find, okay, this system is useful, try it in a demo trading platform for at least 1 or 2 months. And see, okay, it is working for me. Even if I am not watching the market 24 hours, it is working for me. And I am able to control my trades. Whenever I am sitting in front of the computer, I am doing the trade. Rest of the time, I don't have any position in the trading platform. If you are able to get convinced with that, then follow this. Because some people become addicted to trading and they want to keep the position forever. And for them, it will not work. In FX trade, do you have the simpler version of your strategy? There is a lot of observe and follow. I thought that I simplified everything, but still simpler version. The best thing is you watch as soon as you open the platform. Suppose you are in Europe, you open the platform, then you watch the market at least for 30 minutes without committing a position. And you will be able to understand whether they are closer to low, closer to high, and what they are doing there. If they are in the middle level, simply ignore the market. That means they are handling the crosses. In between the low and the high, if they are holding it, that means they are handling the crosses. There is no trading opportunity with regard to the majors at that time. Then you try to focus on the crosses. Otherwise, look for the moves in the majors. Then watch at least for 30 minutes. You will be able to get the real understanding. Okay, they are closer to low, but not the low. Okay, instead of taking 1.6045, you can take 1.6055 the buy position. Still, you will be able to make profit. So, I have given all the techniques to fine-tune the entry. Otherwise, if you see in your observation, they don't breach the low after starting the market, and for 30 minutes, then you take the buy, and by close of the session, you will be able to book 100% the profit. Today, I will demonstrate it. Okay, Stuart, what is the risk to reward ratio for calculating take profit when using? See, as far as risk reward ratio is concerned, it is a theoretical understanding. Risk reward ratio. Okay, when I take 1 part risk, I should be able to earn at least 2 part of reward, or 3 part of reward, or 5 parts of reward. That is a risk reward ratio. Okay, I take 30 pips risk, but I don't really take risk because I use only the hedge order. So when I use the hedge order, when they just drop and hit my hedging, I just watch for 10 to 30 minutes whether hedging is making profit. If it is not making profit, I just close the hedging at entry or with a small loss of 1 or 2 pips or 5 pips and keep another hedge order 5-10 pips below that. When they start rising it, I book profit in that buy position. So ultimately my risk will be about 2 to 5 pips in the event if it is hedged. And if it is not hedged, I just keep stop at entry. So I don't have any risk. And the reward is plenty. And I estimate the reward as up to that of the initial high. And when they go further up, and I try to maximize it. See, theoretically, I can say that they can give a reward of 75 pips, but market has to move. And suddenly people will say that there is no volume in the market. So market has not gone up. So what is the guarantee that when I calculate the risk reward ratio that the market has to really hit my take profit level? They are all theoretical levels. Please understand. And market need not obey with that of the theoretical estimate. And you know that fundamentals, the fundamental data release from various countries, theoretically they estimate the projections for the next quarter or the next month and things like that. So that we call it as the expectations. With regard to non-farm payroll, people expect the higher non-farm payroll numbers. And when the number comes below that, do we think that the market, the US economy is really done bad? That is the estimate, theoretical estimate. Practically, there are certain other problems because of that they are not able to achieve it. But that the market reacts briefly because it is a number. And when they create the hype for the number, you try to jump. And later on, you find that the market makes its own way, the moves, and does not bother about non-farm, they bother about FOMC. That's all. So, when you talk with regard to risk reward, okay, let me just give an example of a risk of 70 pips and a reward of 250 pips in a trade. What you have identified with regard to Fibonacci retracement, 61.8%, you have taken a buy and keep 70 pips stop. And what is the guarantee that the stop is not going to be hit? If the stop is hit, you are going to incur a loss of 70 pips, even though the reward is 210 pips. But you are not going to see that. So don't go with that of the wordings. Practically, you see what are the problems. And I can say when you are driving, you just follow the lane and you follow the signals. You can just move it. But nowhere during the driving, you are taught that somebody can suddenly cross the road and some opposite vehicle can also lose control. How to handle it? It is not being taught. But you have to learn it when you see such scenes. Even though you would not have experienced it, you have to, when you happen to see an accident, okay, what is the causal factor of the accident? So when I am driving, I should avoid such things. So one should be in a position to fine-tune, perfect the art of trading by looking into others' experiences. Then Stuart, what is your, okay, then Stan C. Can you confirm if the Euro USD a false move or the GBP has extra? So Euro GBP dropped, they cut the initial low and came below by 2 pips, so it is a stop it. And in the case of GBP, it is an extended move for 2 hours. Now they started gaining. So I am not pushing it. You can see by your own eyes how they are doing it. So if you develop the capability of reading their intentions, do you require really anything else? It's a man-made market. Please understand that. Aditya. Okay, I'm just wrapping out. Sorry. Okay, I take this opportunity to thank everybody. I'll come back by 14 GMT and take the second part, and I'll try to show the results of the first part trades and also explain to you and continue to monitor the market in relation to that of the US session, early US session. So you kindly track the market from 8:45 to 14 GMT and imagine what would have happened to the trade, and I'll show you the results of the trade and come back. So I expect you to come back and continue to learn the process of trading. If it is suitable, you can put it in your practice. Thank you one and all. See you by 14 GMT.